Topic 13 begins today. This topic deals with uncollectible accounts. This we will find is the downside of businesses granting credit to their customers. Unfortunately, when customers charge something, some of them eventually become bad debts. They don't pay us, and the accountant has to be able to handle that in order to be sure the records are accurate. Now, we are assuming that our business gives credit ourselves to customers. When we deal with credit card sales, the situation is a little different, and we'll talk about that later in the course. But today we're talking about the ABC bookstore, which gives credit to some of its customers. And unfortunately, sometimes that becomes a bad debt, and we have to do some corrections. First of all, I want to look at this screen, and you see a couple financial statements. These are nothing new. We've had these before, but we're getting more detailed as we go through. Certainly the first balance sheet and income statements that you looked at way back last fall were much simpler than these. We're adding more detail. But I show you these again because it impacts what we talk about in topic 13, as we'll see in just a moment. Let's look at, first of all, the balance sheet, and let's look under plant assets, and that's way over here. And we now are dividing assets into two kinds, and I think I told you in topic 12, plant assets basically are reserved for those assets that depreciate, and we had this information, and I want to show you again because it again impacts what we talk about in topic 13. So if we look at this part right here, this is indicating a truck that originally was purchased for $60,000, and we have accumulated depreciation on the truck of $7,500, showing a net of $52,500. As we said way back then, businesses do this because it's important to show what this asset, what the truck cost us originally, which is $60,000, and how much it has worn out. We have accumulated a bunch of depreciation over time, adding up to $7,500. The net value is $52,500. Same thing happens up here with office machines. They depreciate as well. So again, that's shown that way, and it has to be handled that way in the books of the business, the journal, and the ledgers, because the business typically wants to show both the value that the truck had originally and then also the depreciation. If we look over here with sales on the income statement, we have something similar. We have total sales, and we have sales returns and allowances, and we have net sales. One thing to point out here, this company divides sales for cash and sales on account, and that will become important in topic 13, as we'll see. But the total sales is $155,000, but we had some discounts. We got some discounts because we gave some discounts because our customers paid early. So the 7563 actually represents a minus. It says less sales discounts. So we deducted money that customers owed to us. That helped us because we got the money early. We gave them a discount because they're a good customer. We want them to keep coming back to us, and we got their money a little early. The next one also is a minus. Less sales returns and allowances. We just talked about that quite a bit. And that also is a negative. Customers return something to us, totaling $1,550. So this is certainly a negative. We gave money back or we gave credit to the customers. So the two negatives add up to $9,113. You subtract that from the total sales, and you have net sales. Once again, I point this out because it's important for the company to know what their total sales would have been, how much we have granted in discount, and how much we had returned to us. So all of that is important information for the stockholders, for the finance people, because they'll want to know that. They will compare this income statement to past income statements and see if there's a trend in a negative way, particularly with the sales returns and allowances. So that's why it's shown there. So we show all of this information. Now, let's go down to the purchases part. If you look under cost of goods sold, there's much more information here than we had a few topics ago when we talked about figuring cost of goods sold. We'll come back to some of that later, but right now I want to focus on this part right here where we have purchases, purchases discount, purchases returns and allowances, and the net. So once again, this works the opposite of sales returns and allowances. This is how much we bought. The ABC bookstore bought $40,870 in purchases of merchandise, and we got discounts because we paid early. So this reduces the value of the purchases because this was something we did not have to pay. So this was a deduction, less purchases discount. So that's subtracted. Also, purchases, returns, and allowances. Some of it we have returned, so we no longer have it. We can't count it as something of value that we have. So this is a negative of $500. So these two numbers are both subtracted from the original amount of purchases, and you have net purchases here. Net purchases of $38,435. Once again, just like depreciation, just like sales and sales discounts and returns and allowances, purchases work the same way. We want to know how much we purchased. We want to know how much of a discount we got. We want to know how much we returned. So all of that is shown. So once again, I show all those three things, not because we're going to go over them again. We've had them already in different topics. But I want to make the point that we do this with depreciation, we do this with sales, we do this with purchases, and we will also do the same kind of thing, the same kind of theory with uncollectible accounts. So, topic 13, we'll talk about uncollectible accounts. If you look at the balance sheet, this is kind of the end result where we're aiming toward. We have now going to be using accounts receivable again, and we will have something called allowance for uncollectible accounts. So let's take a look at this for just a moment. This works the same way. Accounts receivable would indicate that people owe us money. Our customers owe to us $49,800. But the history of our business, we are the ABC bookstore, and if we look at past months and past years, we can determine that probably not everybody's going to pay us. So probably we're not going to get $49,800. We're going to get less than that. And we will assume that there's a certain percentage of every sale on account that we do not get. So we will be using this information over here, the sales on account. Obviously sales for cash, we have that money, so that doesn't factor into this, but we need to know how much we sold on account. And every business, after a while, knows that a certain percent of that amount of money will not be collected. So we developed something called the allowance for uncollectible accounts. In other words, if you look at this balance sheet on May 31, 2019, we're guessing, but it's a pretty educated guess, we are guessing that $1,500 of that total $150,000 way over here, again, we sold $150,000 during the month of May, we expect that $1,500 of that amount is not going to be collected. So we need to subtract. $1,500 is subtracted from $49,800, and you see the result over here. $48,300 is the net result. So this works the same way as depreciation, sales, and purchases. We need to show the original amount that we did sell on account. We have that much in accounts receivable. We also need to show how much we expect to lose and the net result. So it works in theory the same way as the other parts I have highlighted in yellow. So We are jumping ahead to the end of topic 13 here, but I wanted to show you how this ends up looking on the balance sheet. So once again, it works the same way as the topics from 8 through 12 with depreciation and discounts and returns and allowances. We need to show how much customers owe to us, and also we will show to our stockholders and our finance people, anybody that needs to look at it, how much we expect to lose. And this $48,300 represents the truer amount of money that we expect to get. And if you follow it through, that impacts total assets, and that will impact, total current assets, and it will impact the bottom line as well. So again, as with every video, I'll post this on your course page, and you can go back to it and look at it again if you need to. At this point, I want you to continue on to your course page. There are some questions I want you to answer about this, this video.